PMI is private mortgage insurance. This kicks in whenever you have less than a 20% down payment on a loan for a house. The reason for this is that if you don't have that down payment and you default on your mortgage, this gives some cushion to the bank. So I'm going to take an example. An average home nowadays is $400,000. We're going to assume we don't have 20%. If you had 20%, you don't have PMI, so you don't worry about this. But let's say we only have 5% down, and we're going to take a 30-year fixed rate conventional loan. Now, what would that look like? Well, this is where credit score comes in, and it can cost you a lot if you don't have a good score. Before getting a mortgage, fix your credit score. But let's say you have a 660 credit score, you're going to be paying a 1.23% rate for PMI on whatever the money is that you didn't put down. That, in this instance, it's the other 15%. So that comes out to a monthly PMI cost of about $390 tacked on in addition to your regular mortgage. By the time you get to remove PMI, you will have spent an extra $50,000 on that home just for having a lower credit score. If you have a slightly higher credit score, which is achievable, and I can show you there's different ways to get to a higher credit score without actually spending any money. That would be disputing any errors on your credit report, or if there's any missed payments but you've paid the loan off, you can also dispute that, and in most cases they won't say that it's actually there because they've already received their money. In either case, your credit score instantly goes up within that month. They have about a month to dispute it. If they don't dispute it, guess what? It disappears. So the other one is you can pay off your credit card and other debt down to less than 30% usage, and that's a very high impact on your credit score. So very quickly you can go from, say, a 660 to a 700 or even higher. I went from like a 720 to a 804 credit score fairly quick. Anyway, there's another video on that. But the 700 credit score, you're going to have a 0.79%. You're going to have a $250 monthly PMI cost. Look, just by making that small change, that's going to save $140 a month. So that would be $32,000 of total PMI versus the $50,000. So that saves you, $18,000. We have a credit score. If you have a 760 plus, this is basically where it caps out at. You have a 0.46% PMI rate right now. That would only be $146 a month of additional payments. Over the life of that loan until you get the 20% paid off, effectively it's an extra $19,000. I would prefer always going with 20% down, but when I bought my first house, I was only able to put 5% down. And then I basically paid it off as quick as possible. And within maybe like 3 years or so, I was below the 80% loan to value. You write a nice letter, you say, get rid of my PMI, the lender gets rid of it, and that's great. Or you wait longer, pay more PMI, which I don't like to waste money, and then they take it away once it's about 78% of the loan to value ratio, as long as it's conventional mortgage. If it's FHA, they don't get rid of the PMI until it was the date it was supposed to be removed. So that's why I don't really like FHA. If you're looking to become more financially educated, subscribe. I have a lot more content here, retirement, taxes, basically how to get yourself out of debt, how to make more money, how to save money, keep your money. Thank you for watching. Please subscribe and have a great day.